All right, well, welcome everyone. I'll remind you that there is a chat box down there. So if for some reason you have a question, Haley, I'm not monitoring the chat box. You could just let me know if a question pops up, and I'll be happy to take it as we go along. I wanted to spend January, first of all, in February, as a preview for February's IIG, we're going to be discussing annuities and how they can fit into a portfolio, and especially with the recent volatility from last year and all the downside in the markets, I thought it'd be nice to talk about something that there is potentially no downside or a way to manage downside in your portfolios, whether it's in a qualified plan like a 403B or 457, or if it's with money that is taxable in a trust account or a brokerage account. So next month, if you care to join us, we'll be discussing annuities and some of the facets and things to look for and things to avoid within the annuity space. For this month, as for January here, I don't expect this to be long. Doing some repeat slides, but I wanted, as we go into 2023, and really give people, especially as bad as last year was from a standpoint of portfolios and returns, to give some hope out there of what we have in front of us. But more importantly, pitfalls and things that we are currently seeing in not only portfolios that we look at for prospective clients, but in seeing in some other money managers and just some trends that are happening and things you need to look out for, especially if you're a do-it-yourself type of investor, things you want to try to avoid 2023, some of the psychological things that we as investors struggle with, in particularly something called anchoring, which means holding on to things that worked in the past that aren't necessarily going to work in the future. I think that's a big psychological issue with a lot of our either prospective clients or current clients is, hey, I bought Apple, 15 years ago, it's done so amazing. That doesn't mean the next 15 years are going to be good, right? So it could be good, but that anchoring, that psychological trait of anchoring is very, very difficult to overcome, and it's one thing that I'm going to definitely hit on at the end of the presentation today. So that being said, let's go ahead and get started. Was there anywhere to hide in 2022? Well, quite frankly, there wasn't. And this goes back to the old 60-40 portfolio. A lot of you have heard of this. This is just 60% in stock or equities, as we call them, 40% in bonds or fixed income. And this is going back to 1950. And you've got the green here. The green part of the bar represents the stock or equity return. The gray portion represents fixed income or the bond return. And then the diamond reflects the combination of the two. One of the things I want to point out is typically in these down years, you can even see here in the Great Recession, all through the 2000s and the 1991 recession, you can see bonds acted as a ballast for stocks. So stocks were down. Let's just take 2008, the Great Recession. Stocks down 38% for the year, but if you have the 60-40 portfolio, you're only down 20% because bonds acted as a ballast. You can see the same happened in all 3 years, 2000 through 2002, that stocks acted as a ballast, bonds acted as a ballast for stocks. What made 2022 anomalous, or really an outlier, is that bonds only exacerbated or made portfolios that much worse to the downside, right? You can see here the diamond, the 60-40 portfolio literally had its worst year going all the way back to 1974 or even 1969. You can see here, these are the only other 2 years that bonds acted to the downside. Obviously 74, big inflationary year there, kind of similar to 2022. And you can see it was just as bad, a little worse in the stock market and a little downside added to the bond market. But in 1969, got a similar type of dynamic, but nothing close to what happened in 2022. Just for perspective, 2022 was the worst year in recorded history for fixed income or bond investments. To get down to specifics, as we turn the slide here, we can see how bad it really was from a bond standpoint. 2 years, these are just U.S. Treasuries here, right? So U.S. government bonds, looking at the yields at the end of 2021 and then the yields at the end of 2022. 2021 to 2022, in the 2 year, you had roughly a 400% rise. These are, and this, of course, due to quantitative tightening and, the rapid rise of interest rates by the Federal Reserve, the fastest rise actually, I believe, in recorded history. But you could see what that does, because, if we remember, the analogy I always use for a bond is it's like a teeter-totter or seesaw, those ones you're on, maybe your grandchildren or children play on, where on one side of a bond you have interest rate, and on the other side you have price. So if interest rates are rising rapidly, the price of those bonds is going down equally as rapid, okay? or depending on where that is on the what we call the yield curve. And just to kind of show you that cause and effect, if you look here, 2022 returns and bonds, a 30-year Treasury bond was down 33.29%. The only thing I could think of that was down worse than that last year were REITs, and potentially the NASDAQ was close to that as well. 10 years were down 16.33%, almost in line with the S&P 500. It's 18% downside last year. TIPS, Treasury inflation protected securities, down over 10%. Even corporate bonds shared in the downside, down 13%. Investment grade corporates down 15.76%. Convertible bonds almost 20. Interestingly, a high yield wasn't down nearly as much as some of these other bond classifications because high yield bonds tend to be much more sensitive to stock market performance than they are to interest rates, just because of the credit quality. Mortgage-backed securities were also down 11, 12%. So literally across the board, except for in the very, very short duration and government bonds, all were down 10% or more. And then obviously some of these numbers are really, really catastrophic from a bond standpoint. What's the impact of a 1% rise or fall in interest rates? So the longer you go out on the Treasury yield curve, meaning the further out your bond is before it comes due, the more, and again, going back to my seesaw, I always say, like, you have to think of bonds, if interest rates on one side, price on the other, the price effect for the longer the bond duration is, or the longer it is until the maturity date, right, going further out, it has more of an effect when that teeter-totter is moving. And here you can see a 1% rise in interest rates equates to 13.2% downside in the 30-year Treasury, and a 1% decrease in interest rates, right, so decrease because it's inverse, equates to 21% rise in the underlying price of the bond. And that's really important to know because not all bonds are the same, okay? It always depends on where you are on the curve. So just an interesting dynamic here of what a 1% fall or rise can do with the actual underlying price of your bond. All right, so let's talk about the driver of the underperformance of fixed income last year, fixed income holdings, and particularly stocks that act like fixed income or that have what we call infinite duration, or meaning that they are similar to tech stocks and that they don't have a dividend and they're primarily dependent on growth for valuation, all right? So inflation, good news here. Again, here, some of the good news going into 2023. You can see these recessions as noted by the shaded area here. Here's the 80, 81 recession. Here we have 1991, then 01, 02. Here we have the Great Recession. Here we have the really, really quick recession of the pandemic. You can see here that interest rates tend to peak and begin falling. Headline CPI as well as core CPI, I'm sorry, not interest rates, inflation tends to begin falling before we get through the recession or in the recession, as you can see from the peak here at headline CPI and many of these different, and that's what we think here. We think that the Bureau of, I forget the exact name of it, that's like the Bureau of Economic Labor or something like that, that determines an actual recession in the United States and when it started and when it ends. They tend to come out and say the recession started before the time of the announcement. So highly likely they'll say that the recession started first quarter this year. And our expectation or our prediction is that we will be out of recession by mid-year this year, sometime in the summer. And we will see this CPI or this consumer price index or inflation, if you want to think about, still coming down. Headline CPI in December 2022 was 6.4%. The January number was 5.69%. And we expected that number to come down probably low threes, high twos by the end of the year, and continue to come down because of the deflationary pressure of a recession. Simply, if you think of inflation as too much money chasing too few goods and services. So if we break down inflation and how it came about and what were the main drivers of it, this graph right here shows us that. So this is all of inflation going back to November 21 when it really started to creep in and become a really big problem. We're at 6.8%, and it peaks out here in summer, late summer of 2022, and then begins to decrease, right? Not as quickly as we'd hoped in the beginning, but begins to decrease all the way up until the fall and winter starting of 2022, okay? So what were the big drivers? Well, we could see here back at the peak, one of the biggest drivers, particularly in the summer, was energy, okay? You can see the green portion here represents what part of inflation is energy, and it represented almost, a third of the entire inflationary bar was the rising cost of oil, gas, fuel, et cetera, the fundamental commodities of the economy. That has come down precipitously. You've probably seen that at the pump, where at one point we're paying $6, $7 a gallon. Just drove by the gas station earlier here in Cardiff off of Birmingham, and I saw gas was under $5 a gallon in a couple places. So that has come down significantly. Now, is it back to where it was in 2020 and 2021, early 2021? No, it's not, but it is coming down, and that's a good thing. What is not coming down, or what has been slow to come down, is shelter, or think of that as rents and home prices. And fundamentally, if you think about our economy and how it works, that makes sense. It takes a little bit longer for people to turn over their rental contracts, for landlords to go, okay, great, inflation's coming up, and I have less people calling me about my new rental where I keep raising the price, 5% or whatever each year, 6, 7, 8, 9, 10%, whatever it happens to be. And so now I'm not getting calls on it. So now I have to adjust my prices. Same thing you're seeing in the home buying and selling market. If you look at the home market just here in San Diego, it takes time for home prices to peak and begin to come down, whether softly or precipitously. And the reason for that typically is the largest asset someone owns is their primary residence or their home. And sellers of home tend to look backwards. Where's the first place you look when you go to sell your home? You look on Zillow or Realtor.com or something like that to kind of hopefully get an idea. Your real estate agent tells you, I'm sorry, it's not worth that anymore. It's down 10% at a minimum if you want to sell it. But the majority of people will say, nah, I think it's still worth this, and I want to sell it for this. And the real estate agent wants the listing, so they go ahead and list it at that. But you don't get the offers, and it just takes time for that to work itself into the economy. So, my expectation, February, March, April, May, you're going to actually see this rolling over as well, which will continue to bring down this headline inflationary number. Food at home and restaurants as well, that's beginning to mitigate. Food at home prices have peaked and are coming down as well. And then new and used vehicles, any part of inflation has been absolutely crushed, it's definitely the vehicle market. I saw Tesla just the other day announced a 20% cut in all of their new cars for 2023. So interesting dynamic in that, I think car dealers tend to be sophisticated sellers. They know the market, so they go ahead and get ahead of it. Whereas those of us on real estate tend to anchor or think back in the past, what was my home worth, 6 months ago, because that's when I want to sell it because it's going down. All right. Interest rates and inflation, nominal and real 10-year yields. This is a really interesting graphic because you see here. So real quick, what's the difference between a nominal? So nominal is just what it says, you get paid to own a 10-year treasury. As of January 13th, 2023, that was 3.51%. But you have to take that number and subtract the rate of inflation, and that gets you what's called your real yield or your real return. And you can see here, if you subtract inflation, same day, January 13th, 2023, the real yield on a 10-year treasury is 2.18%. So you're locking in today, based on inflation, a negative real 2.18% rate of return for the next 10 years. Obviously not good. You can see if you look back in history, when these real yields were negative, okay, they tend to bounce back pretty quickly because it's really an outlier, a second or third standard deviation event. And it tends to bounce back quickly because the Fed takes aggressive action in short-term rates, meaning the Fed funds rate. They raise interest rates significantly. They basically siphon off or cut off demand in the general economy, and then yields begin to come down. And that yield curve that we always hear about, that's the short end of U.S. government treasuries versus long end, goes from being really inverted and it starts to flatten out and then become horizontal, which is a typical yield curve, which is also very bullish for stocks. And I'll go on a little bit later about why that's really bullish for stocks and why we think that 2023 is setting up to be a really nice year in the equity markets, and 2024 could be a nice follow-on year on top of that. So let's look at the current inflationary environment and what it's most favorable for. Well, if we look at, in the blue bar is large cap stocks, the purple bar is mid cap stocks, and the green bar is small cap stocks. So for all of 2021 and towards the beginning of 2022, I'd come in here to the IIG and I would tell you, look, if you're going to hide somewhere, we think that there's a high risk of, a recessionary type of event. We think the Fed's going to be very aggressive in tackling inflation. They said they were and they followed through on it. And we said, you want to hide out in these large cap value stocks, companies that have big balance sheets, can do a lot of their own financing, and don't rely on debt markets or VC funding, venture capital funding, or angel investing or private equity to fund them, because the rates of return that those different vehicles are going to require are going to go much higher, which drives valuations lower. Okay. Well, good news is if we're sitting here at the beginning of 2022, we had inflation above 3% and rising. Just going back to the chart, you can see here, roughly last year's time, inflation was just 7.5% and it was rising. And typically returns on stocks, when that's happening, are not good at all. Okay. Well, where are we now? It's above 3% and falling. And I think this is really, really important because, if you work with someone in my industry, or you're working with your Fidelity people, or you're working with whomever, or even doing this stuff yourself, I think it's important to understand you need to be looking forward and not backwards. It's not time to go back and buy those large cap stocks that are protectionary stocks, stuff that's in the Dow. Now it's time to really start looking forward to what we call the pivot, or the Fed not just slowing interest rates, but maybe possibly not slowing the increase in interest rates, but actually maybe reversing their stance and beginning to lower interest rates, because they see that inflation is upon us, recession is upon us, and inflation then would drop precipitously. It's already coming down, not quite as fast, I think, as the Fed would like, but it's already coming down significantly. And the Fed raises interest rates to choke off portions of the economy. It takes a while for those higher rates to affect the overall economy, and we're seeing that now. Typically 28.5% is the forward 1 year return for small cap stocks. I mean, that's a great return. And so, we are advising our clients, let's start, rotating out of these large cap names, especially value names, and start rotating into these smaller cap names. Here's just an idea of how much the valuations have come down from a forward price earnings multiple. You can see big differences between these numbers right here. This is U.S. growth stocks. They've come down the most. U.S. large cap overall has come down significantly as well. You can see value not as much because not as dependent on interest rates. All right. Yield to worst municipals and all these bond valuations have come down, a significant correction in all of them. And if we go back to the long-term median, I think it's important to note that, we're not only setting up for a really, really nice year in 2023 for stocks, but also potentially in the bond market as well. So real quick, average index return during periods of low U.S. GDP growth. So you would think as the economy is roaring and you have high GDP growth, all these small stocks are going to do really, really well. Well, it's counterintuitive, but it's actually the opposite, right? So we have GDP growth below 2%, below 1.5%, or less than 0.5%, which is where we expect to be. Look at what happens to the Russell 1000 growth versus the value stocks, okay? Growth over here, value over here. And this is the box that we think we're going to be in. And the frequency of growth outperforming is 6 out of 6 years when GDP growth is less than 0.5%. So either negative GDP or very low GDP. And that's where we think we're going to be this year for 2023. As I said, first half, probably negative GDP, second half, after we get through the recession to the recovery, are going to see a return to growth, but not enough to increase beyond 0.5% for the year. If that's the case, why would you want to be in these growth stocks? It seems like counterintuitive. The economy's not really growing, but you want to be in a growth stock. It's because, remember, the market is a discounting mechanism for the future. And the stock market is looking 6 to 9 months out. And so what the stock market's doing is saying, all right, the recession's here. We know it's time to start getting out of value stocks and start getting back into the stuff that takes on a little bit more risk and a little more growth. And you may have listened to me for the last 3 or 4 months where I'm saying, hey, it's still time to be defensive, time to be careful about where we're at. In our book of business, we've already begun doing this. We're still buying, DIA, which is the ETF for the Dow, but we're now splitting those purchases between that and small cap growth. And we've just been using the ETF IWO in our book of business for that. And we're still writing calls against those positions. And what I mean by that is hedging the portfolios with options. Because, we certainly, this first quarter, we may not be out of the woods. We could easily go down and test the lows. I think we're sitting right around 4,000, the S&P 500, the lows being around 3,500. It's not out of question to see this market go down another 10, 15% from here. and retest those lows. That could certainly happen. We're not out of the woods yet, but we also want to be looking forward, again, to the Fed pivot into coming out of the recession, which the stock market will lead that by 6 months roughly, 3 to 6 months, potentially further out. So let's take a look at some places that we want to start looking as things begin to turn. So I brought this up, and I haven't really talked about international equity earnings and valuations in a long, long time. But I want to as we think going forward and where are we putting our money, I think you could really, really take a look at global stocks. And what do I mean by that? I mean stuff that's outside of the United States, okay? You can see here 2022, 2023, and 2024. This is the earnings growth. These are estimates, of course, in the future. These are what happened in 2022. We can see, U.S. Earnings growth was still 5%. We know that the stock market came down significantly, but that's because valuations came down, not because there weren't earnings growth. You can see China was 1%, emerging markets 6%, 13% Japan, roughly 15% Europe. But from a valuation standpoint, some of these countries, you can see U.S. currently is at its long-term average. We would call the U.S. market fairly valued, okay? On 12/31/2021, so the end of, not last year, but the end of 2021, we're all the way up here at that 21.2 times. So that was very, very, very overvalued. Here's the 25-year range, way towards the top of that end, right? And you can see here's the 25-year average. So U.S. has only contracted to be average for the last 25 years. Look at some of these other countries, though. Japan, Europe, China, significantly below, particularly here in Europe and Japan, its long-term average. So definitely some places, if you wanted to look outside the United States for stocks, it's some places that you possibly want to take a look at investing, potentially Europe, potentially China, and potentially Japan. Emerging markets, not as attractive right now, pretty fairly valued, as well as United States, pretty fairly valued. So again, it's time, I think, that you can really start looking at some international type stocks and start putting money in those places and not just United States. So 2023 year to date, remember the market is starting to tell us, where we need to be putting our money, and it starts here with consumer sentiment index and subsequent 12 months S&P returns. When consumer confidence or consumer sentiment tends to bottom, we tend to get these nice reversals in the stock market. November 2008, sentiment bottom, we had a 22.2% rally. August of 2011, bottom consumer sentiment, you had a 15.4% return in the market. Consumer sentiment bottomed April 2020, you had a 43.6% return in the stock market. And so here we bottomed late in 2022 in consumer sentiment, and people are starting to think things may get better, or at least they can see the light at the end of the tunnel. Again, we think we're in recession right now, and we think things have gotten pretty bad. I mean, short-term interest rates are so high that if you have revolving debt like credit cards, or maybe you have adjustable rate mortgage and adjusted probably pretty high, or if you have a portfolio loan or something like that, you're paying pretty high interest rates, right? That really, really cuts off the spigot of money flowing into the markets. But now we're seeing the potential for that to start coming down. And so I think that's why you get, sentiment bottoming and potentially a really, really nice rebound here in the markets. Okay, here we'll look back to October 1990, which we think this recession is most similar to the 1991 recession. You had a 29.1% rate of return, right, over the next 12 months. Here's the average subsequent 12-month S&P returns after the 8 sentiment peaks, 4.1% versus the troughs, 24.9% in 12 months. You get a 24.9% return in the S&P 500 this year. The market's going to be right back where it was at the beginning of last year, right? Which would not be uncommon for us to, break out of the recession and the market to really begin to rally. Okay. So here we are year to date, S&P 500 up 4%. At one point it was down, 1%. And I just brought this up here because despite the average intra-year drops of 14.3%, and the S&P 500 tends to drop on average 14.3% every year at some point. Sometimes obviously significantly more like last year, and sometimes significantly less, like going back to 2013 where it didn't drop at all, okay? Annual returns are positive in 32 out of the 43 years. So especially when we have back-to-back with a year down, right, it tends to be positive. The only one that's an anomaly here is the recession that happened in 2001, obviously September 11th, and then a lot of the dot-com bubble unwinding itself. But here we are year to date. So Here we go. Scenarios: return needed to reach the January 2022 peak of 4797. That's the all-time high in the S&P 500. On a one-year standpoint, as I said earlier, 21.7%. If I go back a couple slides, you can see here, once we have this sediment trough, we tend to average 24.9% in the S&P 500 in the subsequent 12 months. So here we are right here, 21.7 is what we need to get back to even essentially in the S&P 500. Not out of the question that by December 31st of 2023, that could easily happen. And then again, if we look at, what type of return we need over the next 2 years, 3 years, 4 or 5 years to get back, it's really not that much because of the compounding. 2 years, 11.3% each year, and then you'd also be back to the peak of 47.97. All right. Again, going back to the theme of U.S. versus international, you can see U.S. outperforming here is the dark box. International outperforming is the purple box, or the purple graph, or returns, excuse me. And this happens to be the U.S. outperformance. EFA, just Europe, Asia, Far East, right? So think of that as an international index. And you can see this is the longest period on history that the United States has significantly outperformed international investments. Did we see a peak after the 2020 pandemic? Well, it's possible. One thing that could be helping lead that is a falling dollar. Remember, falling dollar is very bullish for international and emerging market equities, especially if you're investing in U.S. dollars in those markets. And we potentially saw that peak as well as a peak within the U.S. dollar. So I just want you to keep in mind as you look at rebalancing your portfolios, if you're doing it yourself or speaking with your advisors, just bring up the question. Just say, hey, should we be looking at maybe Europe and emerging markets? I went to this presentation at UCSD, and the advisor there said, hey, this might be a time to consider because the outperformance of U.S. stock has now, let's see, 6.2 years here, 4.2 here, 4 here, 3.3 here, and we're at 15 now. It's not hard to see or think that there could be a significant reversal of this trend. And then here's just the Bloomberg U.S. aggregate, which is corporate bonds, okay? Intra-year declines versus calendar year returns. Despite an average inter-year drop of 3.3%, annual returns are positive in 42 out of 47 years. Okay, 42 out of 47. And we've had 2 years in a row, 2021 and 2022, literally negative return of bonds. And as you can see here, going back to 1976, it's not even close. Bonds, quite frankly, just absolutely got clobbered last year. And a lot of it, again, has to do with inflation and rapidly rising interest rates. We're down year to date here. We do think it's a good time to potentially start adding back to those bond positions and adding back to them pretty aggressively because we do think rates will come down precipitously towards the end of the year. And you want to obviously get ahead of that just like you would in the stock market. So don't forget about bonds. They certainly should be in your portfolio. They should be part of your portfolio. You should be considering them as a ballast for stocks. Last year was an anomaly. Going forward, we see much more of a normal type of environment. All right. So again, global equity markets here. And weights in an all-country world index. The U.S. has become as large a part of the world index as it's ever been, 60%. Okay, 11 in emerging markets, and similar to, and I'll talk about here in a second, a bunch of the Fidelity and UC funds, similar how they were concentrated or over-concentrated in U.S. stocks that like the mega cap tech, and as I talked about that over concentration and the unwinding, this dynamic right here needs to unwind as well. And where's the money going to come from? The outperformance has been the United States, so that will start to float into these other parts of the world. So again, in your conversations with yourself, if you're doing your own investing, or in conversations with your advisor or other folks, please take a look at some of the international holdings and what might be appropriate for your portfolio going forward. Again, just another chart showing one of the same thing. S&P 500 20-year average PE ratio, 15.5 versus 17.4. This is as of January 13th, 2023. And you can see here the all world country index, a 13.1 average, and the current PE is 12.6. So everything outside of the U.S. is undervalued compared to its 20-year average. Everything here in the U.S. is overvalued. And big money managers, they look at this type of stuff, right? And so they'll begin to start putting money in places other than here in the United States. All right, let's review bear markets real quick. Again, this was from my May of of 2022 IIG. And I put this up just because I want to remind you, did I know we were going to go into a deep of a bear market as we did? No. But we put this up because the conditions and the valuations indicated that this was a real possibility. So how long do they last? And I've put this up, I think, the last couple of times we've done this. March 2000 to 2001, roughly down 35%. January to October of 02, down again another 35% or so. We know the big one down 50%, the Great Recession. January to March of 09, another 25%. And that's where we are right now. If we look back at the lows in early October, 25% is where we're down. So, going in line with our prediction of a light to moderate recession, we wouldn't expect to see something like this. We'd expect to see something more like this or this. And that's where we are at right now. So how long does it take for the market to recover? Well, if we think of we really entered in the bear market, probably in, somewhere between the April and May timeframe here in the United States, type of decline, 20% or more in the S&P from 1942 to 2022, so 80-year history year. The average length, 339 days, just under a year, about a month less than a year. If you think of the bear market starting in April or May of last year, and here we are January of 2023, you all out there have ridden through the majority of this bear market. Again, does that mean we may not go back down and test the lows? I can't say that definitively. I don't think we're not up 20% from the bottom, which would indicate a new bull market. We need another, we need another 300 to 400 points on the S&P 500 before a new bull market will be declared. But we certainly could have put in a bottom in October. If we think of the bear market starting last April or May, we could be coming really close to the end of this bear market. We really could be out of it, let's call it February, March, maybe April. And that would put us right in line with an average bear market of 339 days. Again, just another way to look at it. Expansions typically last 47 months or, let's call it 4 years. Recessions typically last 14 months. So if we look at, how many, recession-wise, from trough to peak, if we look again at think about markets, if we think about last April or May, this just tells us that by summer, we should be completely out of recession. So annual returns and inter-year declines, again, this is a repeat of one of my earlier slides. Last year was ugly, and we could see that most years following these ugly years are good. The only time we've had consecutive year over year was going back to the unwinding of the dot-com era. But you have to think about what led into that. Well, what led into this recession? Well, look at these returns, right? You had 30%, 16%, and almost 30% again, right? So that means the bubble got pretty big and it needed to be unwound. But the bubble was so much bigger back here in the late 90s, right? And again, that was concentrated in a lot of the tech stocks. And I know a lot of you got probably pretty hurt during that investing era. But it's very rare that we see these consecutive years down like this, right? So yes, we do expect a positive year, potentially, 1 to 3 years in a row. Central bank tightening, what has caused all of this? Well, inflation certainly, but it's the response to inflation. And this goes back to central bank, rising interest rates by the central bank, by the Fed, and what's happened going all the way back to 2000. This just shows you how steep and how quickly they raised rates, right? And that really choked off everything in the markets. We go back to monetary policy, and the sea change in global monetary policy resulted in literally the first bear market for sovereign bonds, and sovereign just means treasuries, since 1949. Even during the 1970s, the entire decade characterized by high inflation and bond losses, we did not experience a treasury-type bond bear market. Over a decade of nominal bond returns were wiped out in 2022. So going back 10 years, your return was zero if you were in bonds. Again, another reason why we think moving forward, that could actually be the place to be. All right, so real quick, I updated this slide. Here were my warnings from early 2022. I said in the October 2021 IIG, favor value over growth. I am now changing that recommendation. I'm saying now may be the time to pivot, okay? And what do I mean by that? We may have the bear market in our rearview mirror. We may not. We may go down and test, but valuations, particularly in small cap growth, as you'll see in my next slide, are at all-time lows, equivalent to what they were in the Great Recession. That means there's a buying opportunity. Be careful of high valuation names, I said back in early 22. Now is the time to reevaluate smart growth. And what do I mean? Does that mean we start going chasing the Carvanas and the DraftKings and the Zooms and the companies that are down 80, 90%. No, I don't think you do that. I think you need to be in what I call smart growth. Or smart growth is going to be, small caps that are actually growing, that have good balance sheets. Don't just go out there and start buying stocks that are down 80, 90%. You'll be very disappointed. There's a reason they're down 80 or 90% or 70%, like a Facebook, right? So I want you to avoid going and biting off on just because it's been down the most. I don't think what I'm telling you is don't go out and buy all the dogs, right? Smart growth is what you want to look for. Know what's in your funds. Make sure you're diversified from places where money managers will sell. What do I mean by that? Well, let's wait for the next slide. I'll go through that in a little more detail. Mega tech has had way too much over concentration, and not just UC retirement funds, Fidelity funds, index funds. Managers are going to use those large cap tech stocks holdings that they've had for 12, 15 years that have outperformed everything. They're going to use those as a place to use as a cash register to raise cash to begin readjusting their portfolios. So be keenly aware of that. And it's highly likely that those mega cap tech stocks, the Apples, the Facebooks, the Googles, all of Microsoft, Amazon, highly likely those will be far underperformers for the next however many years. And finally, diversification means knowing what differentiates your funds, not just different funds. Move away from funds that all contain the same thing. Make sure you know what's in the funds. So bottom line, and I've used this chart a lot in the last year, the 10 largest Russell 100, which is just the S&P 500 plus the next 500 stocks, as of March 31st, 2000. Okay, here's the list of them. I don't have to read them all out to you, but there's 3 of them that were down, either at 90% or close to 90%. Back in 2000, if I told you General Electric for the next 20 years is going to be down 88%, you would have said no way. So if I tell you Apple's going to be down 88% over the next 20 years, don't say no way, because surely it could happen. It could happen. Is it going to happen? I don't know. Microsoft did very well from then, right? But look at what history tells us. Citigroup down 90%, Lucid down 96.2%, AT&T down 32%, Oracle up 53%, but that's over 20 years. That's nothing. That's essentially no return whatsoever, as well as IBM. So just be aware that those big leaders from today in 10, 20 years may not even be in the S&P 500, not S&P 500, may not even be one of the top 10 companies in the S&P 500. All right. So I went back and I did an update as of this morning of some of these holdings from Fidelity and UC. And again, here's my biggest concern of the UC and Fidelity funds is they still are way over concentrated. Look at this, 7.11% in Microsoft, 4.11% in Apple. Now they are starting to diversify into a group that I've said we think could be the leader in the next bull market. We've said healthcare and banks could certainly be up there, but they're still really, really heavy in some of these tech names. And so just be aware of that as you go through and you look at different funds. Here's Fidelity Contra Fund. They've begun to diversify their portfolio. I like this one a lot better, but they still have Microsoft up here at 6% and Meta, which has been an absolute dog. They've sold it down since we looked at it back in the September timeframe, but I just don't believe that the Meta, Amazon, Google, Apple will be outperformers. So this fund, in my opinion, is positioned to underperform, the overall index and potentially some smart plays in diversifying out of these mega cap tech funds. You see growth, you can still see. I mean, the fund looks almost the exact same as it did as of June 30th, 2022. This is September 30th of 2022. But, Apple at 10% of the fund, Microsoft at 6%, Amazon at almost 6% itself, NVIDIA almost at 6%. Just take those top 4, it's 38%, or excuse me, 20, almost 30% of the fund in 4 mega cap tech stocks. Again, I'm not telling you how to invest or what to invest in. I'm saying don't just pick a fund because it has a low expense ratio, because as you see in the front of it, right? If you are picking different funds, or if you moved out of the UC into, Fidelity, where you have a larger world available to you, make sure you're looking at this and what's in these different funds. Okay. Here's the domestic equity fund, UC. Again, it's almost the exact same thing. It's got all the same names that it did back in the summer of 2022. Here's growth versus value. One of the things I am saying is I do think growth for the next 12 to 24 months is going to far outpace value, because just as extreme as it got up here where growth had way, way outperformed value, and we said, hey, it's time to look at, protecting what you have by being in value stocks. Now we're saying, hey, it's time to put some risk on the table, right? Let's take a look at growth. And again, here's the NASDAQ. And this is why I was saying, be careful as you go through and you start selecting some of these growth stocks. Here's the percentage of NASDAQ stocks down 50% since 2021. Almost 54% of the index was down 50% or more. So make sure you are aligning your portfolio with your risk tolerance. If you really start getting into some of these growthy names, you can really, really get yourself hurt if you're trying to pick individual stocks. Just be careful out there. All right, so where to put money to work in 2023? I put the slide up last month. I want to reiterate it. This is the United States small cap growth forward price earnings estimate. And you can look and see here, we are at the Great Recession lows here and where they were in the pandemic, at the bottom of the pandemic. This looks like an excellent buying opportunity to me to really, really buy well below the long-term average or the long-term trend in growth stocks going all the way back to the mid-90s. I think this is a great spot to look to put money. We're doing it by buying what's called IWO, the small cap growth ETF, and we are still hedging it with calls, but we're definitely building a pretty big fundamental position in that ETF. Performance after recessions, I put this up last month too, but I just want to reiterate, after recession since 1975, look who's the big winner? Small caps, right? Who's the big quote unquote relative loser? Large cap value. So it's really time to start going from here and over here, right? Time to go from here to here. And that's what we're doing in our portfolios, and that's what I would recommend anyone that comes to me, whether they decide to work with us or not. It's really start time to move away from the large cap value stocks, the consumer staples, some of the energy names, and really start looking at some of these growthier names. All right. Finally, FANG, Facebook, Netflix, Amazon, Alphabet, Microsoft, Alphabet, formerly known as Google, that's the G in the FANG, Apple, percentage from the 21 peak to the 22 low. These humongous drops. 77% Facebook, 76% Netflix, Amazon, Alphabet. I just want to remind you that because something worked in the past, it does not mean it's going to work in the future. Those are huge, huge downside numbers, and there are going to be a lot of people in these stocks wanting their money back. So there's going to be a lot of what we call overhead resistance, and a lot of people selling into strength to get out of these names that they really got hurt in. Be aware of this, okay? And just make sure that if you are going to put any money in these names, that you're doing it for a good reason and not because it just necessarily worked in the past. Okay? So with that, I thank you. I think we're done a little bit early here. It's